Today on the Business Owner's Corner, I'd like to talk about market timing a little bit. We hear this all the time. Don't try and time the markets with your investments. Yet, it's pretty tempting to do that. We have all sorts of awful things happening in the Middle East right now. Seems like the US is getting pulled in more and more into that conflict, and the one in Ukraine, we're sending aid over. A lot of people are concerned this might escalate into World War III. That would be bad for the investment markets, among other things. A lot of people are concerned about the election coming up in 2024. There's all these scapegoats giving us reason and excuses to keep money out of the market, maybe wait around for things to kind of materialize and solidify until we become more comfortable at a later date, or to try to get in and out at the right time, thinking that we're going to produce better investment returns than just staying invested over the long run. Today on the Business Owner's Corner, I'm going to lay out the arguments and a whole bunch of data surrounding why we don't want to do that. The first argument we're going to cover today is the large numbers argument. It's pretty easy to punch a couple search terms into YouTube or Google or wherever and find some investment managers who claim to have been able to time the Great Recession and time the COVID drop off in the equity markets. And the reason that you can always find somebody who did it successfully is that there's just a whole bunch of investment managers out there. And what you care about as an investor is not what somebody did in the past. You care about how an active investment manager might perform in the future during the next crisis. That's really what you're trying to do. If you're timing the markets, you're trying to sell before the markets crash, buy back at a lower price, and then take advantage of that appreciation at a later date. And the fact is, there are so many thousands of investment managers around the world that a handful of them, just by the law of large numbers, are going to have to get several calls in a row right. But that doesn't really help us. And here's why. We only care about investment performance going forward. We don't care what somebody's done in the past. We care about what they're going to do in the future for us if we put our money with them or if we try to time the market ourselves. What we're looking at here is a chart from Standard & Poor's. Standard & Poor's has this SPIVA index where they compare the performance of active mutual fund managers, active U.S. equity managers and equities in managers of equities in other countries against the benchmark indices that they're compared against. And what we can see is that in any one year, there's a handful of funds that will do better than their benchmark, and most of their funds will do, most of the funds out there will do worse. And as you can see, the range here going back about 22 years is anywhere between 50 to 70%-ish of all the actively managed equity funds in the US underperform their index. So there's a handful that will outperform every single year. But the longer that we stretch out the timeline, the more likely it is that they're going to underperform. And so here we have the year-to-date numbers on the left, 5 years of performance in the middle, and 15 years of performance on the right. So the longer that we go, the less likely it is that an active fund is going to outperform the index. Anybody can do it in a 1-year period because there's just a lot of managers out there. There's a lot of funds out there. But the longer that we stretch out the timeline, the more likely it's going to be that you underperform. And that's the most relevant point, because if you're going to try to time the market yourself, you're going to have to do better than all these professionals out there. And all these professionals out there, as we can see over long-term time horizons, have been unsuccessful. So you can either try to do it yourself and beat all the professionals who can't do it themselves, or you can try to hire one of the professionals and pick the one that is most likely to outperform in the future. And that's simply impossible. Here's the second argument that we need to cover. This is a chart from BlackRock that has ranked the returns of various asset classes or things that we might invest in inside a portfolio over the last year by year over the last 10. And this is a lot of asset managers have produced this chart over a longer period of time than this. This is just an example. But look how colorful it is and look how random it is. The green boxes are stocks. We have multiple green boxes because they're stocks in the US and various other countries. The yellow boxes are bonds. The red boxes are other things like real estate and commodities and other alternative assets. There is no pattern. There's no consistency to this. It doesn't correlate with interest rates. It doesn't correlate with whether there's a blue or a red president in the White House. It really is random. And all the smartest data scientists in the world, they have not been able to determine in advance which of these asset classes is going to do better than another. So again, this is a situation where if you're trying to time the market, what you're doing is putting consistency and finding a pattern in this data right here, which again, the best, most successful, smartest asset managers in the world have been consistently unable to do. Now, here's another thing that we need to consider. The markets don't wait for any kind of official announcement. This is really the reason that that previous chart is so colorful and why it's so random. This is a chart from Dimensional Fund Advisors that just highlights the stock market performance during the Great Recession between December of 2007 and May of 2009, which you might remember was a really bad period for the markets. Well, the stock market fell over that time period, but the market didn't wait for an official announcement that the recession had begun or that the recession was over. The stock market is just based on a whole bunch of people's expectations for future returns, future cash flows, future profitability from the market, from the stocks that are being traded. There's no impact of an official announcement in the big picture. Markets react way in advance of that, and it's impossible to determine beforehand what's going to zig and what's going to zag. Now, here what we're going to look at, another chart from Dimensional Fund Advisors, is a long-term look at U.S. stock index returns by year. And we've ranked them. So all the red boxes on the left are years where stocks had negative returns. All the green boxes on the right are years where stocks had positive returns. And they're categorized by ranges too. So the worst performing years are on the far left, the best performing years are on the far right. So we have all these years of data during different economic environments, good times, bad times, high interest rates, low interest rates, high inflation, low inflation, being at war, being at peace, all of this. And if we look at the same data expressed just a little bit differently, so now we're looking at monthly data instead of yearly, that's why those little bars are smaller, and over slightly more granular ranges on the horizontal axis, we can see these little colors. And the red colors are the months in which a Republican president was elected, and the blue colors are the months in which a Democratic president was elected. And again, there's no real rhyme or reason. It's more frequent that we have positive returns in any given year in the stock market than it is that we have negative returns. And markets tend to do well in years when a Republican is elected, in years when a Democrat's elected. If we zoom out a little bit, they tend to do well over long periods of time in any event. So there is a huge amount of randomness to the markets that is simply impossible to predict. The most famous, most successful, smartest investment managers in the world are not able to do this consistently. If you're trying to time the market, you're either going to pick the one that you think will in the future and put your money with them, or do it yourself and try to do better than the most experienced, well-rounded, smartest investors in the world. Now, that's one reason that we don't, those are a couple reasons that we don't want to time the markets. We should also talk about the impact of timing the markets, because if you're successful, it will benefit you, but if you're unsuccessful, it will really crush your returns. And so the downside is far greater than the upside. And here's why. Here's a study that Charles Schwab did. Now we're on Schwab's website citing their work, where they took a 20-year period between 2002 and 2022, and they separated investments across 5 different strategies, and they labeled these strategies by name. So you have Peter Perfect, Ashley Average, Matthew Monthly, Rosie Rotten, and Larry Linger. And in these five profiles, they gave each of these investors $2,000 on January 1st of each of these 20-year periods. and they determined what the end result would be under a number of different strategies. Peter Perfect was successful in finding the low point in the S&P 500 every single year of the 20 and put his entire $2,000 to work on that day. Ashley Average took an approach where Ashley Action took a consistent approach of when she received her $2,000, she invested it immediately on January 1st. So she wasn't perfect, but she just put it to work all at once at the very beginning of the year. Matthew Monthly averaged his over the 12-month period. So he took $2,000, divided it by 12. He invested 1/12 of his allotment on January 1st. He invested the next allotment on February 1st, and at the beginning of every single month. He averaged his purchases out throughout the year. Rosie Rotten was the exact opposite of Peter Perfect, where instead of finding the very best or lowest point to invest her money, she found the highest point, so the worst point throughout the year to put her money to work. And Larry Linger did not invest anything. He took the cash and put them in UST bills instead because he didn't want to participate in the market volatility. So my point is this: look at the impact if you have perfect market timing. Peter winds up with $138,000 over a 20-year period. Ashley, who just took everything and invested it immediately on January 1st, only has $11,000 less than that. And look at Rosie, who picked the very worst day of each of the 20 years to put her $2,000 to work. She's trailing, obviously, but not by as much as you would think. And so my point here is that there's not a whole lot of upside to timing this perfectly. It's exceptionally unlikely that you're going to time it perfectly, and there's not a whole lot of upside. But look at the cost of doing it poorly. Now we're looking at another chart from Dimensional Fund Advisors of the growth invested in the of $1,000 invested in the Russell 3000, which is a broader market index that includes big and small companies, over a 25-year period. If you put $1,000 to work in that index in 1998, at the end of 2022, it would be worth $6,356. But look at what happens if you miss some of the best days, which typically happen to be at the very bottom of a market crash because these rebounds tend to be very fast and fierce. If you missed the best week over this 25-year period of market returns, your $1,000 goes from $6,356 down to $5,304. If you miss the worst month over this 25-year period, now you're down to closer to $5,000, which is about $1,300 lighter than if you just been invested the whole time. If you missed the best 3 months, if you missed the best 6 months, now you're substantially hurting your long-term returns. And so my point with all this is that when we try to time the market, it has somewhat limited upside and it has substantial downside if you do miss the best days. And the point here is that it's not when we're in the market, it's how long we're in the market. If you are able to successfully call when the market is going to be high and when it is going to be low, you will be better off if you can buy and sell on all those exact days. My point is that it's not going to leave you that much better off long term than if you didn't try to do that. And it's darn near impossible to pull that off successfully in the first place. So here we're looking at long-term bull markets versus bear markets. We've had 19 bull markets since 1926, 18 bear markets. But the bear markets don't last nearly as long. And by participating in long-term stock market returns, you're simply going to be much better off. So this week's Business Owners Corner is a long-winded way of just reiterating that timing the market is basically impossible consistently over a long period of time, and it really doesn't help you as much as the downside can hurt you if you screw it up. So it's just better to be invested over a long period of time consistently.